Hola, hola y bienvenidos a la discusión más interesante de hoy. Ojalá. Hello and welcome everyone to what I hope will be the most exciting discussion of today's forum, tokenization. So the subject has been discussed by the crypto community for now many years, since the initial bull run of ICOs in 2017. It has recently been discussed a lot by the traditional financial community, where a lot of the investors are looking for cheaper, sleeker, more efficient ways to invest in tokenized assets, in real estate, in infrastructure. So the use case for the tokenizing assets and using blockchain as the technology that could deliver this more sleekly is crystal clear. So I'm here with a panel of esteemed specialists in the area, and we very much hope to forward the discussion on tokenizing assets and understand what's different about it now. My name is Genia Diamond. I've spent my career in traditional finance and recently moved into Web3 community. I now work with startup projects both in TradFi and Web3, trying to help them propel and strengthen their growth. So, without further ado, Anurag, I'm going to just pick you guys like that. So the case for tokenization could almost, we could almost say it's been belabored since 2007. And yes, TradFi is finally catching up, but what's different this time?
It's amazing. You picked the banker on the panel to answer that question. So thank you for that.
Oh, and please introduce yourself first.
Yes. So myself, Anurag from ANZ Banking Group. We are the biggest institutional bank in Australia. Now, thanks for the question, because a lot has changed from 2017. So when we looked at asset tokenization in 2017, and if I take the lens of John, Web3 is a wallet, an asset, and application. So if you just quickly scroll through those things, in 2017, I was introduced to this fox of MetaMask, which is on the wallet sense means there's a single point of failure. If that is gone, all the assets are gone. Fast forward, 2022, and you should search my name or ANZ, and we have a wallet service which is driven out of MPC, which means you will not lose your asset if you ended up missing your key somewhere, which happened with a lot of people. So that's just one example of wallet. If you scale that across to assets and application, we have recently done something where we have tokenized Australian carbon credits and made it available on-chain for the investors. Now, what has changed since 2017? We have on the table with our regulator, our AUSTRAC, ASIC, APRA, Reserve Bank. All four are on the table discussing with us as a party interested in tokenizing carbon credits and saying, these are some of the areas which you have to think about. So when a bank is coming to tokenize an asset, we are taking a risk-first approach. So all the controls which you think about apply in the Web2 world. Is your application resilient? Are you monitoring? One simple example, every single transaction which is attempted on a smart contract, if it is malicious, we have ability to monitor that and trigger emergency response. The reason I'm sharing these examples is they demonstrate how over a period of time from 2017 to 22, the maturity has shifted, and how we have participants in Australia, at least I can speak, where we have a very conducive environment where all the regulators are coming onto the table, and we have a sandbox with Reserve Bank, where you're allowed to experiment with these assets and flesh out what are the risks and how we'll manage it.
Carlos, do you have
Yes,
a view?
so I started my company Securitize in 2017, so I actually do know, as an insider perspective, why it has taken this long to take off. My company, for the ones that don't know, is probably the leading company, at least in the US for sure, in terms of digital asset securities. So these are tokens that represent a security. When you talk about putting real world assets on chain, 99% of the time you're going through a securitization process to basically issue fractional ownership of the asset, and those are investment contracts because they give you, ownership rights and economic rights on the underlying asset. So that's what we call Securitize, and that's what we've been doing since 2017. I think that for the people that were back in the industry at that time, you might remember 2016 was the year of the boom of the ICOs, 2016-17, with the first crypto bull run. And then something happened in July, at least in the US, which is the SEC for the first time. It issued a statement saying ICOs are unregistered sales of securities because you're basically selling an investment contract into an underlying project that does not really exist. And at the time, there was a perception that crypto people will not do illegal stuff if the regulators tell you it's illegal, and they'll move to try to follow securities regulations and put productive assets and real-world assets on chain to extract the advantages of the blockchain, right? That didn't happen. Crypto people continue doing ICOs, and then after that, governance tokens, and then NFTs, and whatever else they could come up with to try to bypass regulations, which has hindered the adoption of regulated assets. Because obviously, when an asset is regulated on chain, it has a bit more friction, right? You have to have some sort of on-chain identity for the wallet. You have to control transfer restrictions because it's a security that is regulated. You have to maybe do disclosures that most crypto tokens don't do any. You have to do maybe filings with the regulator, etc. And then the other thing that has happened is that the traditional asset managers and banks did not get into the space, first because of the bad connotation that blockchain had in 2018 with all the fraud with ICOs, which has continued. And then also because of lack of regulatory clarity. So in our company, we started as thinking that we could just build technology. And after 1 year operating in 2018, we realized we have to become a regulated entity to be able to provide a service and provide comfort to, let's say, an asset manager like KKR or Hamilton Lane, some of our customers, that what we do is legal, right? That you can actually use blockchain as the underlying ledger to represent a security and move it and trade it and service it in a much more efficient way. So fast forward in 2023, first crypto people seem to have come to the conclusion that doing productive things is better for the industry than imaginary internet money on chain. And then the regulatory clarity for the most part is there, at least for what we need. And then companies like ours and others, they have licenses to operate. So this is why you've seen that the last, 12 to 18 months, very large financial institutions have entered the space. So in our case, as I mentioned, KKR, Hamilton Lane, these are very, very large asset managers managing $500 to $800 billion. You've seen projects from JP Morgan, from Goldman Sachs, from the large financial institutions. So I think that we're finally in a place where both things are converging, and I think that the next 5 years, hopefully this will be one of the fastest growing parts of the industry.
Thank you. Karen, maybe a question for you. Things have progressed, as we, I think, are all agreeing here. What areas and what perhaps new things asset managers, investors, users need to consider now when putting their assets, their strategies on chain?
Yeah, so maybe I'll just give you a little background on myself.
Please do.
So I run Re, it's an on-chain reinsurer. Effectively, we back other insurance companies. So we take real-world insurance programs and make them accessible to crypto asset holders. Before this, I ran a Y Combinator-backed insurance company called Cover. So the way to think about this, and especially when I'm reaching out to folks that can provide liquidity to back the insurance programs that we're party to, first and foremost is helping them understand or develop an understanding of the underlying, right? Reinsurance, insurance for insurance is not necessarily something that's easy for folks to grok. But when you get to the point where you can explain it simply, it's, you put down money and all of a sudden, hundreds of insurance companies in the programs they back are sending you insurance premiums, and that's what's driving the economics to the security tokens or the assets that you're buying. First and foremost, they need to know where it's coming from, because they're going to get caught up, or they have been caught up in the quagmire of, are these things self-referential? Are we playing zero-sum games? And in this case, we're primarily driving towards, pulling real-world economics on chain, right? And that's the first thing. The second thing that I find is they're really interested in liquidity, right? They want to know that they can get in and out of positions, and especially in asset classes like real estate or insurance, where you have long-dated contracts that may be illiquid. Tokenization certainly introduces the possibility of being able to create liquidity in markets that otherwise would be illiquid. And we're a customer of Securitize, and this is like a pretty primary thrust, I'm sure, of a lot of your clients. And then the explanation is like, why is this even tokenized? Like, why is this better, right? And candidly, there are amazing people who have built amazing businesses in insurance, and then there are shady people that have built shady businesses in insurance. Transparency around the economics, the cash flows, the reporting, memorializing all of that on chain is super important to be able to drive trust, because at the end of the day, we sell trust. And then compliance. Clearly, we're a regulated entity, and the folks who are investing capital want to know that we're above board with insurance regulators, ostensibly with the SEC, and that we're on a platform or have built the technology that helps enable that, right? So it's like a whole package.
If I can quickly add to that. So one point which you said about liquidity, and one example which has really drove this home for us. We had this investor who really believes in net zero carbon footprint. They have bought significant amount of carbon credits, which they aim to retire in next 3 years. So they will offset their carbon footprint this year, next year, and the year after. And this investor comes to us and says, I have X million of carbon credits sitting in my mailbox. Carbon credits are just certificates. And imagine a world where something which is very useful for our environment, for people to take exposure to, doesn't have active market. And hence, people have those assets sitting in their email boxes. By tokenizing, you're making them liquid. And that's another big change from 2017 to now, is people are realizing the need for efficient market for real-world assets. And that's, I think, will continue to grow. And you will see more and more traditional financial institutions entering the market for that reason.
Thank you. So, Pat, let me ask you the most difficult question here on the panel. I'll just pick you like that. So we hear from Carlos that all the big managers, hundreds of billions of dollars, are knocking on his door. He can hardly manage with the traffic of the inquiries. Australian government is behind it. You've got a suite of insurance product around tokenization. So it is happening. There is momentum here. Shall we be worried about the liquidity mismatch? What happens if we sell fundamentally illiquid assets like infrastructure, houses, private equity, and suddenly everyone wants to sell? So shall we be worried, Patrick?
Yeah. Hi, everybody. First of all, thanks for having me. My name is Pat Hourigan. I'm the founder of Defyca Frictionless Markets. We're a Luxembourg-based fund and tokenization platform. We focus specifically on the debt markets. So that question is really apt for debt markets. I think there's sort of two questions in it. One, what are general challenges, and then what are very specific challenges. So general challenges, anyone who's interested in this area, I encourage you to go web search, Google search, FSB, Financial Stability Board, DeFi report from last February, just gone. It's interesting stuff. It kind of points out many of the real challenges that I think Carlos and his team at Securitize and anybody who's in this area has uncovered over the last number of years. For me, there's sort of two general areas. If you intend on asset managers using blockchain, what you're really intending on doing is bringing the best caliber products on chain. That's really what it's about, right? So if you're bringing the best caliber products, those caliber products are managed professionally by high caliber investment managers and asset managers today. Those asset managers are well capable and have a strong track record of dealing with scenarios like liquidity mismatches. So today, when you look at why isn't there a plethora of these asset classes on chain? Like, the first reason is the unit economics actually don't quite work just yet. There's a good example of this, the Franklin Templeton Money Market Fund. It's a US repo and treasury fund. It's knocking out about 4.5%. It's based on Stellar's treasury, mostly. But the management fees in that and the operational expenses are about 8.5%. So you're literally losing money, right? Now, it's subsidized for the moment, but the costs that are in there come from the fact that you're running two ledgers, a traditional ledger system, and you're running an on-chain ledger system. So those costs have to be addressed, right? And the best way they get addressed is by having more participants and more competition in the market. So that's the first thing. The second thing is most asset managers, in general, seek to lower their levels of risk. Those risks are split across a whole different range of risk classifications. One thing for certain is that they will not take on currency risk, right? It's just not necessary, because when they deal with tokenization, they got to deal with technological risk, operational risk of these smaller companies, because they're startups. They've got to deal with lots of other risk structures. Currency risk is one of these big issues. Much is made about this idea of atomic settlement or instant delivery versus payment in the tokenization space. In order for that to actually work, you need a super, super low cost currency that moves frictionlessly across boundaries. Today, if you look at the cost structures that are in place for qualified custodians, they're outrageous. You're talking about 30, 50 basis points. Some of these money market funds, they can only survive on 20 to 30 basis points of costs, right? So those are big challenges. Eventually they get overcome. Regulatory is another one. You look in Europe. In Europe now we have the European Financial Digital Package that's at various stages of adoption. You have MiCA, you have the DLTR regime, you have DORA. You put all of those things together and suddenly you're giving regulatory comfort to larger asset managers. Just a question about liquidity mismatch. There's sort of this, I think 5 years ago, and maybe still today, some people believe that tokenization endows magical properties on an asset class. Yeah, it doesn't, right? It really doesn't. It promises different aspects and different characteristics. So one of the things that it promises is that you can frictionlessly move these digital securities across different boundaries. But you can really only do that within safeguards and guardrails. So when you look at liquidity mismatching, this is probably one of the biggest areas for regulatory intervention in the traditional markets today, right? Wind back 6 weeks ago when SPV failed, that's a liquidity mismatch. FTX, that's a liquidity mismatch, right? It's when the actual redemption of the fractionalized tokens that you have, those redemptions outstrip your ability to liquidate the underlying assets. It's not unique in the tokenization space. It happens in mutual funds. You can go, again, web search, look for ECB reports on liquidity mismatching in open-ended funds. This happens all the time. So it's not unique, or it's not an ailment specifically to tokenization. It does present an opportunity, though, because if you look at how tokenization functions, there is an opportunity for larger balance sheets to come along, market makers to come along, and to provide the liquidity that's needed in order to have shorter-term redemptions on longer-dated underlying mature assets, right? Those are, I think what will happen over time is that you will see asset managers becoming comfortable with the fact that their assets, first of all, can be tokenized and distributed safely within the guardrails that are there, but then you also will have more participants coming into the market to provide the necessary liquidity to keep the system juiced. I think that's what will happen.
I just want to comment on the liquidity issue, because obviously one of the main reasons the asset managers want to tokenize is obviously for operational efficiencies, eliminated reconciliation errors, being able to scale to more investors, etc., which talks to what Pat was saying about the fees of these funds, right? So if they can actually become digital, then they can actually reduce the cost of operating a fund, and then they can reduce the fees. So that's one aspect of it. The other one is liquidity, right? Because obviously one of the reasons why many asset classes like private equity or venture capital, et cetera, are not actually suitable for individual investors is because it's lack of liquidity. Because if you're a pension fund, you can just take a long-term view on an asset, 10 years, invest it, leave the money there, it'll come back at some point in time, et cetera. But if you're an individual investor and you don't know what your personal situation is going to be, you can get fired from your job, or or you get married and have 4 kids and you need money, or you get divorced and lose half of your money. Like, there's so many things can happen in your life that requires that your assets have some degree of liquidity. Now, so how do you solve for liquidity for illiquid assets? So, well, there's 2 ways to do it. One, what Pat was referring to as trying to liquidate the underlying assets to provide liquidity, and that's where it gets tricky, because first, it might not be easy to liquidate the underlying assets, and second, there might be a liquidity mismatch, that those assets are actually not worth enough at that point in time to be able to return the money, which is what happened to the banks, etc. I disagree that this is what happened to FTX. What happened to FTX is they didn't have the money because they stole it, so that's a different problem. But what happened to SVB was not fraud, right? It was just basically liquidity mismatch. Now, there's another way to provide liquidity, which is having somebody else to buy the asset. And if you think about how it works in traditional finance, if you're a very large investor and you buy $100 million on a private equity, healthcare fund from KKR, which is the one we tokenize on Avalanche, you're going to find somebody to buy it at, a discount from the net asset value of the fund. Let's say, 85, 90 cents on a dollar. But if you have $100,000, not $100 million, nobody's going to bother to do it because the whole process of buying a piece of a private equity firm is just so cumbersome and it's so costly that it doesn't scale well. So what tokenization really brings to the table is not necessarily that it enhances liquidity for any magical reason, it's just that it automates the process of, identifying the provenance of the asset. Yes, I own this because I have the token, being able to move it in an efficient way to another owner, being able to settle the trade quickly without counterparty risk. And that allows, the liquidity providers that work at large scale to come down and, operate at a much smaller scale. So that's where liquidity, I think, is going to come, and not necessarily because the asset itself is something that is liquid. We're also tokenizing, credit funds that have daily liquidity with Hamilton Lane, and we use tokenization as a way to, improve the redemption process using USDC and all that stuff. So that's a different part of the industry. But for liquid assets, the liquidity comes from liquidity providers, not from the asset itself. So.
I don't want to belabor it, but we're a stylized example of this, right? We're tokenizing reinsurance contracts. They tend to be long dated, tend to be liquid. The way that we get around this, at least the first part, the explicit redemption of the underlying, just be very, very clear, right? That you're in long dated contracts and the collateral that you can pull out of those contracts, in our case, is actuarially gated. In other instances, gated by the ability to produce cash, right? But the second part is kind of what's super interesting. It's like effectively creating synthetic derivatives on top of this underlying that are now tradable. And right now, yes, there are always going to be liquidity concerns, especially within captive platforms. But the idea here is if you've got broader participation in general, and right now it's primarily institutional investors, but over time, broader participation, liquidity should come.
Look, since we're in Barcelona, so I don't know if whoever's never been here, there's a very nice Picasso museum. So Picasso was not born in Barcelona. I grew up here and have a very good museum here, and he's a very popular painter, right? But if you own a Picasso that is worth $10 million and you want to get liquidity, you need two things. One, you need to find somebody that likes the paint, and second, that it has $10 million. So it's not easy. But if you can actually provide a very efficient fractional ownership, you can find somebody that likes to own, $10,000 of an underlying Picasso because they know that, historically has appreciated in value over time, right? And that's a way to provide liquidity without having to, sell the entire piece and finding, it's easier to find 10,000 people that have $10,000 that like Picasso and finding one that has $10 million, right? So that's the other way that you can bring liquidity to illiquid assets by providing a very efficient way of providing fractional ownership and selling those pieces.
And it's not a new concept. I mean, mutual funds have existed for a long time. Much of what happens in the tokenization space is basically a mutual fund. That's basically what it is, right?
Thank you, guys. Now, question maybe I wanted to start with Carlos, but I think maybe you will all have a view on that. Just to take that Picasso example, wonderful thing. As you all mentioned, the adoption so far has been primarily with institutions, but we need adoptions from mass affluent, from wider community. So what if they come to you and say, Carlos, but what if this is a Russian Putin's family office that owns the Picasso? What if there's fraud? What if there's bad things? And every time I open the newspaper, they tell me everyone in crypto is blowing up. So what do you tell these people? Because there are good answers, right?
Actually, if you think about what a lot of crypto companies blew up is because they were committing fraud or they were incompetent or a combination of both, and nobody knew, right? So I know crypto people hate to be regulated and have security and say that things are securities, but securities regulations are there for a reason, primarily for providing investor protection. And they've been there for many, many, many years. In the case of the US securities laws, almost 100 years now. And then investor protection is important, right? Because investor protection is all about disclosure. So I'm going to tell you, if you buy my asset, what am I going to be doing with that money? What is the underlying asset? If you lie, then it's a pretty illegal thing. But if you give money to somebody in crypto you literally have no idea what they're doing with the money, and that's what happened with FTX, that they were, giving it to a sister company. That's buying stuff in Bahamas, or Celsius, that was doing some stupid investments in the back and couldn't pay the yields. That's the problem, right? So the fact that real-world assets, 99%, as I mentioned at the beginning, are going to end up being securities, and then therefore securities are regulated, and they force disclosures on the underlying asset, and there's penalties if you don't follow the rules, etc. It actually gives more comfort to, or should give more comfort to industry participants. And then to answer your question about, somebody, I don't know, from a sanctioned country like Russia today, being able to buy a tokenized asset, that's pretty impossible, right? Because those assets are sold or traded through regulated entities like our company. We have to do KYC to the investors. We have to attach a wallet to that real world ID and create some sort of on-chain identity. We have to, run AML checks on the wallets as well as on the person, etc. So it basically prevents that thing from happening.
Maybe now a question to the whole panel again. So your projects, to various degrees, are quite focused on tokenization. And there is a lot of discussions. The use case is clear. However, the mass adoption, the inflection point, isn't here yet. So what happens if it's not here for the next 2, 3, 5 years? Are we still going to be around on this panel? How dependent is your business success on that inflection point being soon?
I can kick that off. The short answer of it is we're in a macro environment that does not treat businesses that burn significant amounts of cash kindly, right? As a general principle in this environment, you want to be building a little black box that takes in a little bit of money and spits out more money on the other end. And the rate at which that is done can vary, but you want to be as close to cash flow neutral or cash flow positive as possible for the foreseeable future. And that's how we're solving it. We're running a profitable business that is compounding. And liquidity, tokenization, the broader access to a global reinsurance market will come and will be accelerated in a crypto summer. But you got to be able to stand on your own 2 feet.
I will take a different lens to that. The way we are dealing with that is reducing the barriers for our users to interact with us. Expecting a big organization to first have a wallet before buying an asset from you, you have already created barriers to entry. We have recently done a transaction where, from an investor perspective who is buying a carbon credit, they understand two-factor authentication. They understand the account number. Account number happens to be a wallet address of Ethereum in that case. And when you purchase, the transaction gets settled and you own it. If you want to get to the mass adoption, there are some of the principles which crypto community was, I think, too focused on. You still want on-chain custody of the asset by the user, but it doesn't have to be at the expense of making it too hard and onerous for the user to go on the journey. They today understand two-factor authentication. They understand, they see an image, they understand the data. They know if I add to the cart and purchase it, it will work. And in our view, that will be the key to success, to bring your next billion users to the platform of blockchain, reducing those barriers. And if whoever is able to do that successfully will continue to survive.
Well, Anurag, you of course represent the largest bank in Australia, so whether the tokenization happens or disappears tomorrow, you're still going to be here. Now, Pat, what about you?
Yeah, you'd look at the other end of the scale. Actually, can I start by just paying a compliment to Securitize, because they actually have done this stuff from the ground up. They have broken the ice on this, right? They've gone to KKR. That is some achievement to be able to get probably the largest leveraged buyout, private equity, private credit fund in the world to believe in what you're doing. And certainly, because of that, a lot of conversations happen. right? That's a fact.
Thank you.
Right? So the question you ask, what's the inflection point and what happens if it doesn't arrive? The inflection point is dependent on the market that you're in, honestly. There is no global market for this stuff. It depends on the market you're in. If you're in the US, there are certain rules and behaviors you must exhibit in order to be able to attract the market and be able to distribute. In Europe, similar, right? Actually, because this is a regulated space, the inflection point, sadly, is regulation. Regulation has to be there. Otherwise, asset managers will not provide the best caliber products for you to tokenize, distribute, and sell. It's as simple as that, right? So when the inflection point is that, then there's other little inflection points that come along the line. Like, honestly, asset managers at present will not touch a stable coin. Like, why would you do it? First of all, it costs you more money. There's a risk associated with it. Your wallets can be drained. Why do it? You're not going to touch this stuff. What you're going to look for is fiat-based distributions at present. So that's another inflection point. And perhaps if CBDCs become a reality, and if there are venerable stablecoin issuers in Europe and in the United States, although there's an ill wind in the United States at the moment, but if there are venerable stablecoin issuers in the market, you might see more adoption of it. Your other part of your question, what happens?
So
We'll be goosed. We'll think of something else to do. Yeah, I mean, that's it.
I want to say thank to Pat for his night words, and just a small anecdote. I've actually met the KKR people in 2018. So this was for like 4 years in the working, and as I mentioned at the beginning, 2018, nobody was ready. We were not ready. We were a small company with like 15 employees. We just closed our first $10 million in funding. We didn't have any licenses. The KKR team also didn't understand really well. They heard about tokenization, but they didn't know exactly what they wanted to achieve, etc. I mean, if you fast forward 5 years, it's a very different story. We've raised over $100 million, have 150 employees, millions of dollars in revenue, credible investors like Morgan Stanley, etc. So that companies like KKR feel comfortable, and I kind of appreciate the impact that has done in the industry, because a lot of people told me that the fact that we managed to bring that company first has triggered many other companies, Hamilton Lane, Apollo, etc., to start participating in the space. So I think that from an asset manager perspective, we sort of solve temporarily the supply problem, right? Because they're all interested now. Now it's going to take, a little bit more time, because some of them are very large companies, conservatives, but I don't feel that that's going to be the problem of getting quality assets on chain. Now, where the problem is in the adoption from the investor side of things, right? And then there's two kind of investors that you could try to sell this, right? One, crypto people. And the crypto people know USDC, stable coins, they know wallets, they know how to connect to a protocol, how to, hold a token and stuff like that. And I think that so far they have not been interested in anything that was regulated, because so many unregulated assets were providing these imaginary yields, but they look like very good yields. Like, you could put the USDT, the Terra Luna, and 20% on the Anchor protocol, and people go crazy about those things. I think that's changing, and the fact that this panel, the room is so full of people, is actually very encouraging, because it means crypto people have an appetite for real stuff on chain for the first time. And then to bring like traditional investors, that's where it's going to be a bit more difficult, because there's so many problems there in terms of user experience using blockchain, like wallets. How do you connect a wallet? What happens if you lose your keys? Like, who does custody? There's where do I buy USDC to purchase this asset? Like, that part, I think, will still have a bit more time to solve it. And as Pat said, you need to provide a little bit of more traditional rails for onboarding those investors, while the crypto people already are crypto native and they can onboard in these assets in a much easier way. So,
Now, in the remaining 2 minutes, question to maybe one or two of you. So we're here, hosted by very gracious hosts in one of the most beautiful cities in the world, but hopefully we're not here just because of that. So why is it that you guys are building on Avalanche?
I can kick that off. Subnets are what attracted us to Avalanche. There are things that we pull in hundreds of thousands of policyholders, and there's information that needs to be available in a permissioned way. But I think more like a fundamental, perhaps philosophical level, you look at evergreen subnets, it's everything that we're going to need, right? Avalanche is making a directionally correct, and I talked to Avalanche about this, directionally correct, concentrated bet on where things are going to go, and it's the room being full and us being here is a testament to that. So the rate of change and the focus is very attractive to folks like us.
Thank you.
I just want to add something. So great technology, whatever, but they also have a great team. And for me, that's important, that I can pick up the phone, talk to John Boo, talk to John Nahas, Morgan, and somebody, and those are people that are very knowledgeable, very helpful, very, as he said, very focused on trying to solve this issue. And I think that, to me, that it makes it easy for me to partner with Avalabs and use Avalanche, that some other entities that don't have a person you can talk to when you have a problem or you want to do something. So,
thank you. Well, they are great. Well, on this cheery note,